Hi everyone, I'm Joel, a research analyst at IFAS. Joining me today is Ong Xun Xiang, Head of ETFs at LionGlobal Investors. In this episode, we discuss the LionGlobal Singapore Physical Gold ETF, Singapore's first gold ETF backed by allocated gold that is insured and vaulted in Singapore. We will explore how this ETF differs from other gold investment options and examine why gold may serve as a strategic component for investors seeking portfolio diversification. So Xun Xiang, we've seen gold prices reaching all-time highs recently. Why is this happening, and do you think gold will continue to grow?
So gold's recent rise to all-time highs is not driven by a single short-term event. It reflects a combination of structural and macroeconomic drivers. Heightened geopolitical tensions, persistent inflation concerns, and increased market volatility have prompted both investors and institutions to reassess portfolio resilience and diversification. Historically, gold has shown this ability to navigate different market cycles and economic shocks, with long-term gains outweighing periods of drawdowns. So one important shift has been the behavior of central banks. Since 2023, governments around the world have been increasing their gold reserves steadily. So as central banks globally diversify away from the US dollar, gold has outweighed the US dollar in global reserves since August 2025. So it's the first time this has happened since year 2000, and it reflects growing concerns around concentration risk, especially when US government debt levels remain high and geopolitical fragmentation continues. And in this environment, gold has re-emerged as a neutral and long-term store of value.
With that in mind, what is gold's role in a diversified portfolio, and should gold be in investors' portfolios?
So gold's appeal extends beyond short-term market stress. Over the long term, gold has historically preserved purchasing power and tends to appreciate against paper currencies. Prolonged periods of quantitative easing and low interest rates after the global financial crisis have further highlighted the gradual erosion of fiat currency value compared to gold. In addition, gold is priced in US dollars. So this means a weaker US dollar naturally supports higher gold prices, and it makes gold a useful counterweight in portfolios with significant US dollar exposure. And when taken together, all these characteristics reinforce gold's role not only during periods of crisis, but also as a long-term diversifier. As a result, gold continues to play a meaningful role in portfolios, not just as a crisis hedge, but also as a long-term diversifier and long-term store of value in an evolving global financial system. From a portfolio construction perspective, gold has historically functioned as a diversifier rather than a standalone return-seeking asset. So this can be seen in the data. When we include a 10% allocation to gold in a global or Singapore-focused portfolio, we observed that the portfolio with gold achieved high returns with lower overall volatility. And this highlights gold's ability to enhance portfolio resilience across numerous market cycles. When we include gold with equities and bonds in a portfolio, investors may improve diversification and reduce overall portfolio risk, especially during periods of market stress when traditional asset relationships no longer behave as expected.
So one of the functions that you mentioned is that gold is a store of value, and this is seen by many investors as well. But recently, prices have seen significantly short-term volatility. Does this undermine the case for holding gold, particularly for more risk-averse investors?
So traditionally, US Treasuries have been seen as the ultimate safe haven asset, especially during equity market sell-offs. However, recent heightened interest rate volatility have shown that bonds do not always provide the diversification that investors expect. In numerous episodes, equities and bonds have come under pressure at the same time. So in this kind of scenario, gold has increasingly stood out, especially during periods of market stress. So since year 2000, there has been 10 equity market downturns, and gold has delivered positive returns in 9 out of these 10 equity market downturns. So importantly, investing in gold is not about short-term speculation or even betting about higher prices. It is an allocation decision considering how much of a portfolio that gold should represent and the role it plays together with traditional asset classes. So given the 3 long-term drivers we observe for investing in gold, it could be beneficial to accumulate gold when attractive entry points appear.
So you've talked about the benefits of having gold in a diversified portfolio, but what are the current ways for investing in gold?
So there are several ways for different investors to invest in gold, and each option comes with trade-offs. So physical gold or gold bullion provides direct ownership, but this requires investors to manage storage, insurance, and also security. Smaller gold bars also have higher markups and wider bid-ask spreads. And all these can reduce cost efficiency over time. Gold-related equities, for example like gold mining stocks, provide indirect exposure to gold prices, but they are also influenced by company-specific and operational risks. So this means that performance might not always move in tandem with the price of gold. So this is where a physical gold ETF provides a more efficient alternative. There's direct exposure to gold prices. It is exchange traded for liquidity and transparency. And it removes the need for investors to handle storage or handle insurance. The LionGlobal Singapore Physical Gold ETF combines allocated physical gold backing with secure vaulting in Singapore, jurisdictional safety, and insurance on the full value of its allocated gold holdings. So this allows investors to assess gold as a potential diversifier and long-term store of value in a convenient and cost-efficient structure.
What advantages does the LionGlobal Singapore Physical Gold ETF offer compared to other gold ETFs or holding physical gold directly?
So compared to other funds backed by physical gold, the LionGlobal Singapore Physical Gold ETF provides insurance coverage on the full value of its allocated gold holdings. So this offers investors an added layer of assurance over the protection of their physical gold. So buying physical gold directly involves a lot of practical considerations. You have to arrange storage, vaulting, secure insurance coverage, manage numerous logistics and also verification, and dealing with higher costs for smaller bar sizes. And smaller gold bars also come with higher markups, higher bid-ask spreads, and all these can significantly increase total cost over time, especially for retail investors. So comparatively, the LionGlobal Singapore Physical Gold ETF buys gold at institutional scale, shares storage and insurance costs across investors, and charges a transparent total expense ratio of 0.39% per annum. So this helps investors avoid the inefficiency with buying and holding small gold bars directly.
What kind of investors is this ETF suitable for?
In uncertain times, investors usually buy gold for long-term value preservation. De-dollarization, inflation, and geopolitical tensions have been the key trends we noticed recently. So this ETF might be suitable for investors that seek portfolio resilience and diversification. Investors who want exposure to physical gold without managing the custody themselves, or investors that value Singapore jurisdictional safety, together with full insurance coverage. The ETF structure also offers real-time pricing and real-time liquidity. So with trading bot lot size as low as 1 unit, investors can buy this ETF with as little as US $5.
I noticed that you have both a listed and an unlisted share class, so what is the difference between the two?
So this is a common question asked by many different investors. Both the listed class, which is the ETF, and the unlisted classes invest in the same physical gold portfolio, which has been incepted since the 1st of December in 2025. So this makes it Singapore's first commodities fund with both listed and unlisted share classes, and they track the same benchmark. But the difference lies in investor preference. So the unlisted share class uniquely offers Sing dollar hedge exposure, while the ETF share class provides US dollar unhedged exposure. But it is tradable on the SGX in both Sing dollar counter and US dollar trading counters.
Any closing comments for our audience?
So the LionGlobal Singapore Physical Gold ETF is the first gold ETF backed by physical gold, insured and vaulted in Singapore. It offers a differentiated combination of asset security, transparency, and accessibility. And by bringing together investment-grade physical gold, Singapore-based custody, and the convenience of an ETF structure, LGI aims to provide investors with a robust building block to navigate uncertainty and strengthen portfolio resilience. This ETF is an excluded investment product, also known as EIP, so it's accessible to all investors. It is open for subscription during the initial offer period from 6th to 20th March at USD $5 per unit. It will be listed on the SGX from the 26th of March onwards.
Thank you, Xun Xiang, for sharing your insights with us. For viewers who would like to learn more about the LionGlobal Singapore Physical Gold ETF, please visit the LionGlobal Investors website for further information.